Welcome to the annual Private Equity and Venture Capital Compensation Report Summary. In our many years of publishing the annual report, both before and after the market crash, we've seen significant changes in how private equity and VC comp works. Both firms and individual investment professionals count on us to present a comprehensive benchmark that's reliable and affordable, and we take this responsibility very seriously. Because of our dedication, the Private Equity Compensation Report has grown to become the most comprehensive benchmark for private equity and VC comp practices in the entire industry. Annually, the PrivateEquityCompensation.com team conducts a comprehensive survey to reveal insights into the changing landscape of private equity compensation. The data is collected in Q4 of each year to get the best picture of how the year will wrap up. And all of the data is collected directly from private equity and venture capital professionals. With more than 40 detailed charts and graphs, we prepared this report to help you better understand industry pay benchmarks and changes that have happened in private equity and VC comp. The full report answers these questions and more. What are the compensation averages and ranges? What's the base and bonus payouts? Which titles earn the most and how do they earn? Who shares in carried interest and at what level do they share? What forms of carry are people negotiating? And how does fund size affect pay? How does fund performance affect pay, especially when it comes to the bonus? How are these professionals landing their jobs? Because we've seen that change as well. And how has the work culture changed? That is, as things have gotten better over the years, how has that affected people who work within private equity and venture capital firms? Now, before we talk about comp practices, it is important to understand the big picture. And private equity started slow in 2013, but it built momentum throughout the year. And here are some of the highlights from the team over at pitchbook.com. The first is, capital is up. Worldwide, the private equity industry had $636 billion of investments in 2013, which is a 13% increase over 2012's numbers. A large chunk of that increase came from just 2 take-private buyouts, and they accounted for a combined $48 billion of the $71 billion difference. Now, the number of deals are down. Even though capital invested was up last year, deal activity actually dropped by about 5% and hit the 2010 levels. Traditional buyouts dropped about 13% to less than 1,300 deals, which was even less than the number of deals in 2010. Now, while North America companies didn't get as much attention on the buyout side of things, Europe, on the other hand, became a bigger target for this. Both deal activity and capital invested gained significantly in Europe in 2013. There was also more fundraising. The fundraising trail looked a bit smoother in 2013. Total capital raised increased by 59% over 2012, up from $188 billion to $299 billion. In addition, the percentage of funds that hit their fundraising targets in 2013 rose more than 10 points, with the average time to close a fund dropping from 13 months in 2012 to only 11 months in 2013. Now, the number of new funds is down. There weren't as many first-year funds in 2013, and they dropped significantly from 105 in 2012 to only 74 in 2013. It seems that limited partners are increasingly headed towards the bigger, more experienced money managers and those more established funds. And finally, there's still lots of dry powder out there. So even though fundraising activity and exit activity will continue to grow, you've got to keep in mind that there's over $700 billion in dry powder ready to be invested. And that means that the priority moving forward for 2014 and probably 2015 will be on making new investments. Now let's take a look at the industry itself and those who are working in it. Again, this year, most respondents represented the mid-career stage, with nearly 60% having between 6 and 15 years of work experience. The largest cohort remains those with 10 to 15 years of work experience, slightly outnumbering those in the 6 to 9 year category. So this is important to keep in mind as we look at the compensation numbers, because this is the majority that makes up those numbers. There seems to be a myth about a very defined line between private equity and venture capital. Traditionally, we think of private equity firms handling the big M&A and LBO transactions, while the VC firms might be doing early to later stage investments of startup companies or those looking to go public. In practice, however, there's quite a bit of overlap. In fact, 16% of the respondents told us that they work at a firm that utilizes both private equity and venture capital investment strategies. Depending on whether the firm is a venture capital or a pure play private equity team, we know that compensation varies substantially between respondents with similar titles. This reflects the differences in responsibility between the firms, and also it highlights the risk of focusing excessively on title when you're trying to compare your compensation. Again this year, the data says that those that work in VC firms earn smaller base salaries on average. We saw that bonuses this year were highest in the hybrid firms, those that take advantage of both private equity and venture capital investment strategies. Respondents at funds above $100 million indicated substantially higher compensation this year. Last year, we saw a gap in terms of compensation between medium-sized funds and large funds. This year, that gap closed, and those in the mid-sized funds earned slightly more, due to both higher average base and bonus payouts. Similar to last year, most respondents to the survey are part of a group of less than 10 team members. However, there are several subtle changes in the results that may show notable trends. There has been an increase in the number of individuals working in groups of 5 or less, which is a reversal of what we saw last year when the same demographic decreased. The number of employees working in groups in excess of 50 also decreased. Less than 5% of respondents now indicate that they're part of a group of 50 or more, whereas last year that number was about 7%. When we look at the compensation by firm and group size, it's clear that you should consider these size factors when developing your career plan, if you're an individual and you're looking at salary and bonus potential, and if you're setting benchmarks for your firm's compensation practices in terms of just managing the talent that's out there and making sure that you understand that there is competition for that top talent. Again this year, most respondents are expecting an increase in comp. In terms of the 2013 pay, 63% of professionals are expecting an increase in pay, a number that's held pretty steady from the 2012 level of 62%. This trend reflects a steady growth trend within the industry when it comes to cash earnings. On average, this year's bonuses are reported at 39% of total comp, which is up slightly from 36% last year. At the higher levels, the story really changes though. Bonuses contribute more than 70% of cash earnings for those taking home more than $1 million. Those earning over $500,000 saw more earnings coming from bonuses than in their base salaries. The inverse was true for those earning less than $500,000. This year, there's a clear correlation between bonus payouts and fund performance, much in line with an overall shift that we've seen in the industry towards linking compensation more directly with investor returns. Now, we should note that just over 3% said their fund would end up in the red this year, and those anticipating negative returns the year before, that number was 6%. Again this year, the numbers surrounding guaranteed bonuses have remained stable. The percentage of respondents that receive none of their bonus guaranteed has increased to about 73%. On the other hand, those receiving fully guaranteed bonuses increased to 7% from 5% the year before. While overall we've seen stability throughout the range, this does show a minor shift towards the extremes of either no guarantee or a full guarantee when it comes to incentive pay. In most cases, cash compensation increased along with the size of the fund. Analysts saw the biggest differences in cash comp between small and large funds. Analysts at big funds on average earn nearly double that of their peers in the smaller funds. And although somewhat higher base salaries were in place for analysts at larger funds, this differential was mostly bonus dependent. We were closely watching cash comp trends in 2013 because we anticipated that the carried interest tax break was in jeopardy. It looks like carry will live to fight another day, so we don't think there will be any major shifts in how private equity and VC comp is structured in the near term. Due to the correlation with position within the firm, work experience remains a leading factor in carried interest allocations. At the 6 to 9 years of experience range, the percentage of professionals participating in carry increases significantly. And after 10 years in the workforce, however, the participation percentage is relatively flat. As expected, participation in carried interest pool is mostly reserved for those at the highest levels of the team. In particular, we're finding that the associates are increasingly being left on the sidelines. This year, both associates and senior associates saw their participation levels fall. On the other hand, senior professionals such as partners, managing directors, and vice presidents continue to enjoy regular participation in the carried interest allocation. And again, work experience remains a leading factor in carried interest allocation, which really shouldn't be that surprising due to the correlation with someone's experience and the level of their position at the firm. The Private Equity Comp Report has grown to become the most comprehensive benchmark in the industry. Unfortunately, we don't have time on this video to go through the entire Private Equity Comp Report and all 46 detailed charts and graphs that are specifically designed to help you understand pay benchmarks and guidelines in the private equity and VC comp practices. If you're interested in learning more about private equity comp practices, you can purchase and download the full report instantly at privateequitycompensation.com. Thank you and good luck with your efforts, whether you are negotiating your own compensation package or setting benchmarks for your firm's compensation policies. We hope you found the report helpful.